Hey everyone, welcome to Dr. Frank's Finance World. I'm Dr. Frank the Bank because I try to teach you something about finance so you can make a little money on. This is the last of the videos. This is the problems we're working out where we do all of the calculations. It's not just handed to you of part two. So be sure to subscribe and get notifications. I'll be working on some derivatives videos next by looking in the notes for links, and there are the full out calculate from the beginning to end problems. So get the cash flow function calculator going because we're going to work on it. So in the first problem, you see Seattle Corp has been presented with an investment chance that will yield end of year cash flows of $30,000 per year in years 1 through 4, $35,000 per year in years 5 through 9, and $40,000 in year 10. This investment will cost the firm $150,000 today, and the firm's cost of capital is 10%. So you can see at timeline 0, there was no change in working capital or anything. It's simply the $150,000. And when you see that it was a $30,000 positive cash flow in years 1 through 4, CF1 was $30,000, and the frequency is 4. The next cash flow is $35,000 for years 5 through 9, so 5, 6, 7, 8, 9. So that is a CF2 of $35,000 with a frequency of 5. And then a CF3 of $40,000, the final cash flow, and a frequency of 1. So when you put this in your calculator, we can go ahead and do that. Probably helps to see it. So let's clear out the calculator. Time period 1 is 150 negative, and enter. And C01 was 30,000, and it actually occurs 4 times, so we entered that as 30. And it occurs 4 times for years 1 through 4. The second cash flow is 35,000, and that actually occurred 5 times, so frequency of 5. And then finally, you have your final year cash flow of $40,000. So we enter that as well, and that occurs once. We know that our cost of capital is 10%. We want to know the net present value, so we hit the NPV key. Put in 10% for I. We come down to compute. We find out it has a positive net present value, so it's going to earn more than 10%, and it's actually going to make the firm $51,140, well, $38.20, but anyway, pretty doggone close there. So that is where you have the different frequency of the event. That's the one thing to consider as well. So this is the all-out problem, and we're going to work it out one step at a time. You've been asked by the president of your company to evaluate the proposed acquisition of a new special use truck. Truck's base price is $50,000. It will cost another $10,000 to modify it, so you have $60,000 of it right from the start. For a special use by your firm, the truck will be depreciated over 4 years and will then be sold for $20,000. So we can calculate our basis. If it's $60,000 in the truck, we're going to keep $20,000 for the end. You're going to write off $40,000 along the way. So anyway, use of the truck will require an increase in net operating working capital of $2,000. The truck will have no effect on revenues, but is expected to save $20,000 per year. So it's interesting. A lot of these examples, we say, hey, it's going to make this much money. But the reality is if it saves money, that is also another type of problem. Or not, it's not a problem, it's opportunity, I guess, but another type of problem to work. So what is the initial investment? Well, we put the 50 plus the 10 into the truck. That was 60,000. And then we had our 2,000 working capital. So it's 62,000 out of pocket right off the bat. And then what is the operating cash flow? Well, we're going to calculate the depreciation first. If it's 60,000 for the truck and 20,000 is salvage, we're going to depreciate $40,000 over 4 years, so that ends up being $10,000 per year in depreciation expense. We say that the earnings before taxes is $20,000. It's great that it saves us money, but guess what? We met another $20,000, and Uncle Sam wants his take. So 40% of 20 gives you $8,000. So we will net effectively $12,000 as net income. So when we take our net income of 12 and we add our 10,000 depreciation, each of the cash flows for years 1 through 4 will be $22,000. Well, it's 1 through 3. It's another 22 in year 4, but we add terminal value to it. So what's the terminal value? There's your 22,000 operating cash flow, and you get your 2,000 working capital back, we're presuming we sell the truck for exactly what we wrote it off on, so $20,000, so there's no tax ramifications. So the terminal cash flow will be $44,000. So the way this would look is CF0 is minus 62. C01 is 22,000 with a frequency of 3. Here's 1, 2, and 3. C02 is this 44,000. We don't have a cost of capital, so we couldn't do a net present value, although we could do an internal rate of return on this problem. And here's another type of problem that you're going to see. Assume a project costs $100,000, provides $28,000 in earnings before taxes. So I'm giving you the little mini income statement, but you're going to have to pull out taxes to get net income. And you get that for 6 years. It requires a $15,000 increase in working capital. We depreciate straight line over 6 years and sell it for 20 at the end of the year 6. If the discount rate's 11%, what are these? So we put $100,000 into the project and another $15,000 in working capital. So CF0 is going to be minus 115, what we paid for it plus the working capital money we had to put down. C01 is going to be this function of, let me pull the calculator up so we can get this here, the 28,000 in earnings before taxes. So let's do 28,000. But we don't get to keep it all because we're in a 30% tax bracket. So we get to keep 70 cents of every dollar. So what we actually have as a net income is 19,600. That's why I had the 19.6K right there. If we had a $100,000 investment and we sell it for 20,000, there's an $80,000 basis, 100,000 minus the 20,000. So the depreciable basis is $80,000, and we're doing that over the 6 years. So when we divide by 6, we see 13,300 in depreciation every single year. Get out of the net present value thing here. So there is our net income. There is our depreciation. We have a cash flow for years 1 through 5 of $32,900. So that's F01 is for 5 times. The last year we have the same 32,900, plus we sell our equipment for 20,000, plus we get our working capital back, and that becomes 67.9. So if we look at that from a cash flow standpoint, let's just clear this out. CF0 is 115 negative, or 15,000. C01 is this 32.9, and it actually occurs 5 times on the 6-year project. The 6th year is different, so we enter that, and it occurs 5 of the 6 years. And finally, the terminal cash flow was at 32.9 plus the salvage, plus the working capital coming back. So that was 67.9. And that actually occurs once. So now what would be the internal rate of return? I want you to notice IRR stands independent of our cost of capital of the firm. The project just is what it is, and it earns what it earns. And the internal rate of return on this, when we compute it, is actually 96% there. So almost 22%. And since if anything below 22% cost of capital, in theory, this would have a positive net present value. The other things is how many years to our payback. What we would do then is take the 115, and we're going to get 33,000 cents a year for our first 5 years. We know we will pay it back. 33 times 5 is 165. So we know we're going to pay it back using those payments. So all I did was say the 100,000, oh, sorry, the 100,000 that we're out because we get our working capital back. 100,000 that we're out minus divided by 32 is 3.04 years. So it takes a little over 3 years to get our initial investment back. All right, and finally, when we're here, that you could have looked at, some people pull the working capital out, some don't. You could sell your working capital at any point in time, but to get the 115 back, it would take a little longer, but you'd still do the same process. It depends on whether you realize we could sell the working capital at any given point in time for what we have in it, in theory. Anywho, your firm's considering purchasing some new equipment that will pack your product faster and cheaper. The equipment costs $350,000, but it will save $50,000 per year for the next 8 years. So that's going to be the earnings before taxes. Working capital requirements is another $20,000. Excuse me. The salvage value is going to be 25. If the firm's tax rate is 35%, up to what required rate of return should the firm invest in the project? So there you have your CF0, the 350 plus the 20 and working capital extra that you had to put in there. You would have let's see, required product. Yep, and then you have the 55,000. If you pay 65% or 35% taxes on it, you get to keep 65. So if you take the 55 times what you get to keep, 0.65, you realize that the net income then each year is $35,750. Depreciation wise, you had the equipment at 350,000, but you think you're going to salvage it out at 25,000. So you have 325,000 depreciable basis. It's going to be over 8 years. So if you take 325,000 and divide it by 8, you're actually writing off depreciation wise $40,625 every year. So your cash flow is your net income plus your 40,000, a little more of depreciation. Each year, your cash flow is going to be $76,375. Your final cash flow is you sell it for its salvage value of 25, and you get your working capital back. So the final cash flow is 121,375. And when we put that in the calculator, we get initial cash flow 370 negative. The CF0 is the 76.375. We're going to get that for 7 years. The 8th year is going to be different, but all those 7 years is going to be, C01 is going to be the same for those 7 years. And finally, the last cash flow, the terminal cash flow, is this 121,375. And that occurs once. And finally, we know that our cost of capital is 15%. So when we hit the NPV and enter 15, we can see whether the project pays for itself or not. And the answer is it does not. You would lose about $12,500 investing in this project, which shows you, therefore, that the project did not earn the 15%. So we know the IRR is going to be less. I know we wouldn't have to compute this, but we know it's going to be less than 15%. So when we compute the IRR, indeed, it's about 14%. So the project only made you about 14%. You needed 15% to earn the cost of your money. Therefore, it's a negative net present value. And no, you would not invest in that project. That's net present value, folks. Please send me emails with comments and suggestions or any questions for Ask Dr. Frank. Have a great day. We'll talk about derivatives next. See you. Bye-bye.